Good morning, folks. My name is Robert Coulter. I'm the General Manager for Partnerships here at the AFA. I'm delighted to be hosting and introducing you to today's webinar titled Assessing the Opportunities for Equity Income. Equity Income Fund Portfolio Manager Michael O'Neill will discuss how Investors Mutual's cautious and highly selective approach to investing and prudent use of option strategies is seeking to generate consistent and reliable income in the current environment. For those advisors with retiree clients seeking income in this record low interest rate environment, this session will provide insight into investing in Australian equities as a source of income. I'd like to introduce our guest speaker today, Michael O'Neill, Portfolio Manager for the Investors Mutual Equity Income Fund. As a portfolio manager for IML, Michael is responsible for managing 50% of Investors Mutual's All Industrial Share Fund and 50% of Investors Mutual's Equity Income Fund, as well as covering the financial sector. Michael became an equities analyst with boutique firm Canay Capital Partners in 2008, which later merged with IML in 2010. His sector responsibilities have included banks, insurance, diversified financials, media, discretionary retail, food and beverage, and information technology. Prior to his role as an equities analyst, Michael was an actuary with the Commonwealth Treasury. So before we begin, I'd just like to cover off some webinar housekeeping. Today's webinar will attract one CPD point, so we will send that out to you within the next week. We'll also answer questions at the end of the presentation. So please use the Q&A function. You'll see that in front of you with the tick, not the chat function, if you could, as the diagram on the slide suggests. Michael, I am particularly looking forward to hearing your presentation today. And for anyone who read the Australian Financial Review this morning, is particularly topical with the APRA announcement. Thank you for putting this important information together for our members. Let's kick off. Over to you, Michael.
Thanks very much, Rob, and thank you to the Association of Financial Advisors for hosting today. I do appreciate everyone for tuning in for this presentation. Now, we all know what the challenges are for investors these days, particularly those seeking income to fund a retirement. You know, with cash rates at record lows worldwide, bond yields very low, the traditional income classes that you'd think of as low risk, even residential property with rents under pressure, are difficult to generate sufficient income in retirement. So you think about compounding low rates for a 20-year retirement, it's very difficult for people to plan with those levels of income. So in this environment, equity income is a necessary evil, but the trick is doing it prudently without taking undue risk and also using volatility to your advantage. Now, we are in an unprecedented time for markets. We were expecting some sort of correction in global markets given the strength that they've had over recent years. Some sectors came into March looking particularly fully priced. There was a degree of exuberance. However, nobody would have expected a correction in the form of that which we've seen with a global pandemic, with businesses shutting their doors, with global trade and supply chains being challenged, and in some cases, some defensive businesses proving to be less so because their businesses were significantly interrupted. So we saw this swing in valuations from exuberance to hopelessness and then back again in record time. The markets were down 30% worldwide from their February peak to their March 23rd lows, and there was a short window in which to deploy cash in March at reasonable valuations before stimulus saw markets rise rapidly again. And stimulus has been unprecedented. We are now back at the point where the market in many geographies is pricing in a V-shaped economic recovery. So it is time to be cautious if you're going to invest in markets, it's time to be selective. Really think about what you're investing in and what the downside risk that's priced into the share price is. And also think about scenarios, because I challenge anyone who knows where the economy is going to be in a year's time from now. We've also seen a rise of day trading, and it's understandable that with people taking money early out of their super, maybe receiving some stimulus payments or JobKeeper, working from home, they've started to, in some cases, gamble on the share market. We've seen a rise of Facebook groups with, tips, a lot of speculation on stocks like Zip Money and Afterpay, and you may well have read about Robinhood with its commission-free trading. Now, we'd caution investors who are putting their own money to work, given that markets are in a shaky period and valuation risk is there. Also, the economy is quite uncertain. We released a book last year called 20 Lessons for 20 Years. It includes a lot of lessons that we've learned from different cycles. One of the lessons is always know the difference between speculating and investing. So right now that is key, and there are some companies that you can forecast with a high degree of confidence, and there are others where what scenario plays out has a big impact on their share price and their earnings. So be cautious. The challenges presented by low rates are well known. In Australia, we've got 25 basis point cash rate. We've seen 10-year bonds at 90 basis points, and term deposits pay about 1%. Even junk bonds have retraced substantially from their peak levels because of the acts of the Fed. So without getting your income from these traditional sources, where do you go to? We've also seen plenty of companies on the ASX either raising money, deferring their dividends, or even not providing guidance. And we think the August reporting season should be quite telling. So there are actually 50 companies in the ASX 300 that raise money dilutively, forever increasing their share count. And there were about a third who cut their dividend or deferred it. The banks being a particular cohort with a need to conserve capital. So in this environment, the trailing yield of the index it's around about 3.5% or so, is potentially unsustainable. So there is risk in owning the index for yield. However, what we'll show you today is that if you're a bit more active in your approach, if you dig a little bit deeper down at the stock level, if you are a stock picker by nature, you can find opportunities to generate income with more certainty, and you can use options around this to enhance that income while dividends are uncertain. So our philosophy at IML has always been around finding those companies with enduring competitive advantages. So we don't want to find companies that are exposed to either structural change or behavioural change. And as you'd expect, during COVID, there's the opportunistic companies who are reshaping their businesses for the new environment and who have capital available to do so. And then there's also those whose business model might have been outmoded, who are even more challenged by an acceleration in behavioural change. So you've got to think carefully about this, because winners of the past may not be winners of the future. But then again, equally, some market leaders may emerge stronger if they have capacity to reinvest. We like recurring earnings. We're very cautious of cyclical earnings, where we have to factor in a positive economic scenario in order to reach a share price target that makes sense. So really, we like businesses where we can confidently project earnings out 3 to 5 years, and that tends to lend itself to more defensive companies. We like capable management. There's not that many management teams in the market today that have been through a recession, so it's more important than ever during this uncertain period that you have a well-experienced and credentialed management team. And we do like companies who can grow, because ultimately a share price is driven not only by the rating against its earnings, but also the growth in those earnings over time. The trick is finding those businesses at a reasonable price when rates are so low. And we did actually release a piece on that topic Do valuations and PE ratios matter when the cost of money is zero, which is on our website? It's worth having a look at. Our current focus in this environment is really on bottom-up analysis of company fundamentals. This is more important than ever. There are winners and losers. You'll imagine when COVID first hit, we were on the phone to anyone we could talk to in the industry to just get a read on what was happening, particularly when it came to global supply chains, flexibility, cash flow generation. So assessing where the best opportunities are starts with bottom-up analysis, and the first red flag is balance sheets. Knowing a company's balance sheet is strong enough to withstand, a V, a U, or even an L-shaped recovery, because raising money at a discount permanently dilutes your shares, your earnings per share. Franchise strength is more important than ever. As I said, the ability to reinvest and improve your franchise could see companies coming out of this even stronger. And long duration assets are very important and tend to carry a premium when rates are low. Management experience is key. We obviously like talking to management teams that have a plan for different scenarios rather than those who are holding to a particular forecast, because we don't know. And we like to look for attractive and accessible valuations, in some case underpinned by a really recurring business model with a predictable cash flow. So one traditional source of income that retirees and retail direct investors have often relied on is the banks. And it's quite clear why that has been a reliable source of income. It's been a sector that, not only the shares themselves, but the hybrids have had fairly predictable distributions or dividends over time with franking. So you can see the appeal. In Australia, we have a strong banking system. In fact, if we look at the banks today versus the GFC, they're holding a lot more capital and their funding positions are a lot better. In fact, with investment, with accounts now paying low rates and with also subsidised funding from the government, funding costs have never been lower than they are today. So there are some positives. The weight of stimulus that they've received has been a real positive in terms of Team Australia's response to COVID-19. The problem with the banks, though, is their gearing. Even though their capital is strong, between the four major banks, they have $2.8 trillion of lending on their books, of which about $1.7 trillion is mortgages. And if you want to think about the leverage of that, there is only $260 billion backing that $2.8 trillion book. So household debt has come into this period at record highs. We've seen the regulator extend the deferral measures for COVID loans from September to March. And the reason is just to avoid that September cliff, as they call it, during what's a vulnerable period. So household debt will be higher post these deferrals. The issue with the September cliff partly has to do with gathering information, because as you'd understand, bad debts are highly uncertain, and with the opaque accounting treatment and regulatory treatment for bad debts, there's a real need for the regulator to gather as much information on the ground as possible. The trouble is the big banks are taking time to go through their hardship cases. When they quote a level of people who have had unaffected incomes, this may be a small portion of their overall books. And also, a lot of the people that they'll be talking to may have had some support from JobKeeper. In truth, we won't really know the real economic scenario until these deferrals roll off and until stimulus measures are removed. We've got 500,000 mortgages in deferral, and we've got about 269 billion of total loans, which is about 10% of the book. So you can see the size of the problem. Now, banks went into this with structurally lower returns, because simply if you have a lower cash rate, the earnings they make on deposits, it's squeezed. Fees have been under pressure since the Royal Commission, and also remediation cost bills are rising. So We're cautious banks. The dividend outlook will be clouded for the foreseeable future. We don't expect them to return to the normal 5 to 6% yields until 2022 financial year. So really we see more potential if we focus in on the less cyclical non-bank industrial stocks. Another sector that's been a go-to source of income for retirees and for income investors more generally is property. And people are drawn to property because of the bond-like characteristics. As an equity class, they have recurring rents. We've seen them, the valuations appreciate because they are being compared to bonds. So with rates falling, valuations have gone up. And really, the proposition in property, the main concern we have is valuation. In the retail class, that was seen as the premier class in Australia. The reason is we've had a very strong supply-demand dynamic between landlords and tenants. You've had global retailers looking to come in and fill space, so rents have been a high proportion of sales in the high teens in Australia. We saw that as quite exposed. We came into this thinking rents, if vacancies ticked up, would potentially fall. Of course, COVID has accelerated this, and we saw in May that retail property trusts were some of the most impacted by COVID because they were only able to collect 52% of rent due in May, and it could get worse. In fact, some of the biggest retailers, such as Inditex, which owns some 7,400 different locations across the world, of which 2,100 are Zara stores, has actually flagged that even though it's one of the most profitable, has some of the most profitable tenants, it's going to look to shut 500 stores per annum for 3 years, and that's 20% of their footprint from one of the most profitable retailer groups in the world. They're redirecting that towards online. So you can see how, you know, the situation of supply and demand could well reverse. In the office side, Australian office was at the peak of a 10-year cycle. And the issue with office property is that if you have an empty office space, the marginal cost of filling that space is virtually zero. Therefore, in order to bring in cash flow, you will discount to fill the space. So you can see huge swings in office valuations peak to trough, and we saw in the GFC about a 30% fall in valuations peak to trough. The dynamic on the demand side is not clear, working from home, but by the same token, if you're in the office, perhaps you're spreading people out a bit more, but supply is coming on. So we expect office valuations are exposed. Where we do invest in property trusts, we focus on those with manageable debt levels, with high weighted average lease expiries, so 10-year leases, and with defensive anchor tenants. So think about the more defensive tenants that, such as Woolworths, Wesfarmers, and Coles. Now, in this environment, diversification is key to achieve your income objectives. Because we've got low rates and because our traditional low-risk classes pay low yields, we turn to industrial dividends. The ASX 300 yield may be exposed, particularly given the concentration of financials, but you can earn decent yields from quality industrial stocks. So if we start with yields from quality industrials, we can add to that some level of option premium. In our funds, we take a very plain vanilla approach to options. Think about the situation where you own a stock, it's gone up in price. You would ordinarily be trimming your position, but you can sell a call option which says, you know, say in 3 months' time, if the stock price is above a certain level, our counterparty has the right to buy it off us at that fixed level. So you've effectively locked in or targeted a higher exit price than the current share price. You've collected some income and you've reduced the volatility of that income. Now the VIX today, or the fear index on the market, is at levels of 25 to 30. What that says to us is the economics environment is uncertain. Company earnings and dividends are uncertain, as we'll see in the upcoming reporting season. So for as long as earnings and dividends are uncertain, the VIX will be high and option premium will be accessible at a higher level than normal. In fact, I'll show you some examples. We're currently earning higher levels of option premium than that shown on the table there. So if we have three sources of income, the diversification gives us some confidence in meeting our targets of at least 2% above the ASX 300 yield after fees and pre-franking. And the only other thing to bear in mind is option income is not seasonal like dividends. It's available all year round, which allows us to smooth our quarterly distributions. Now, I just want to talk to you about a couple of examples of income favourites, core holdings in our equity income fund that might not be top of mind when you think about equity income investing. The first one is AusNet. Now, AusNet is not a household name. It is a regulated utility, so it provides essential infrastructure assets across electricity distribution, transmission, and gas distribution, primarily all located in Victoria. So think about gas, poles, wires, and pipelines. So these are the transmission vehicles for electricity and gas. They have highly predictable revenues and earnings. In fact, they operate under a regulatory regime which locks in 5 years forward earnings. Revenue is 25 to 40%. When you receive an electricity bill, 25 to 40% of that bill relates to network charges, which are remitted directly to the network owners like AusNet. So you can see how that is a low-risk revenue stream, and we'll talk a bit more about that. But more importantly, AusNet not only has a secure yield, it's also got a growing asset base, as you can see in that chart there. It has been growing 6.25% per annum since 2011 financial year. So the key is that under the regulatory regime with the Australian Energy Regulator, there's a lock-in of revenues in 5-year intervals. This gives us cash flow and distribution certainty. So in the long term, we also have growth aided by growth in the asset base. And one dynamic we're seeing right now is the gradual transition away from traditional sources like coal to renewables. So AusNet is in a great position to connect these new renewable assets into the grid and to earn a contracted revenue for that and to grow its asset base. It's currently trading on a FY21 dividend yield of 5.5%, 50% franked, and we do expect that to grow 2 to 3% per annum. Now, this asset offers some downside protection as well. Because they operate under a revenue cap, it means that they don't take a lot of volume risk. So the way it works is if you have a period of low demand, say weather is benign, you're not having as much use of electricity in the home, you can, in the following year, they can increase their tariffs to recoup the revenues that they didn't make in the prior year. So this is how they, under the regulatory regime, how their returns are smoothed by the regulator. They also don't take a lot of customer risk. So it should be top of mind at the moment. What if customers can't pay their bills? People are under financial strain. Well, in this case, because the 25 to 40% of the bill is remitted straight to the network operator, most of the risk is borne by the retailers themselves. And you can think about the retailers like AGL, Origin, Alinta, etc. They have very big market shares and they have strong balance sheets. So the credit risk you're taking is very low. So really we have a fair degree of confidence in these cash flows given the downside protection of this stock. We think it's a very good core holding in our income fund, and certainly it stands out on a risk return basis in stark contrast to some of the property trusts which pay similar yields. Another example of a regulated utility similar to AusNet is Spark Infrastructure, that's SKI. I won't go into it in great detail, but similarly it has regulated assets operating in electricity in Victoria and New South Wales. Similar characteristics, in its case, pricing on a 5% yield. We see AusNet as better relative value, but we have and do continue to own some Spark as well. Horizon is another stock that might not be on the top of your head when you think about income investing. It is the largest rail and freight company in the country. It transports coal from mines to ports. So it owns the Queensland rail infrastructure, and it also owns everything that runs above that network, the trucks and trains. The haulage business is 40% of the revenue. That operates on over 10-year contracts to provide haulage services, locomotives and wagons, and they provide that to the better producers of coal. Australia tends to be on the lower part of the cost curve. Australian coal tends to be high quality. What really attracts us to Horizon, however, is the 60% regulated below rail business, which is the actual network infrastructure asset. They've negotiated a 10-year lease between the miners and themselves and have had it approved by the regulator. So there's very secure returns attached to that business. This is one stock that we were able to buy in the sell-off in March. It sold off with the market. It's defensive. It didn't deserve to, but markets tend to sell off in tandem. Correlations tend to increase. The bargains we found during that March period were very much the defensive businesses. So we were able to buy it on $4, which is about 16 times PE and over a 6% fully franked yield. It did rally. It did rally towards what we thought was a fair price. And in this case, when it hit $4.80, we were able to go into the market and sell call options. We were taking the risk that if it went above $4.80, we would lose the stock to the counterparty at that strike price. But we were getting over 20 cents compensation. So we're targeting an exit price of over $5, which we were happy with. And you can see the reasons we think this is such a secure business. Because the dividend growth for the last 9 years has been very steady, and the infrastructure assets and the security of returns has, if anything, increased over that period. So just to go to our options strategies, people often hear the word options and get a bit spooked, and there is reason to. There are some option strategies that are very systematic, that create higher risk and higher turnover, and that aren't very transparent. Our strategies are very, very simple. So we are a fundamental investment house. We buy stocks when we think they are cheap relative to our valuations, and we have 10 analysts looking at stocks every day, specialists in their field, trying to put valuations with confidence and also trying to put downside cases. So if a stock is approaching what we think is a buy price, we can sell a put option. We collect some income in advance, but we have to be prepared to take that stock if it keeps falling. So as you'd imagine, if we focus on defensive stocks where we have confident valuations, we can do this. Equally, if we own a stock because it's cheap and because it's quality and value, if it runs towards our price target, we can start looking at selling call options, collecting some income, targeting a higher exit price. But of course, again, as a fundamental investor, we have to be prepared to lose the stock as it continues to run. So options are just merely an extension of our buy and sell framework. And option income is always relevant, perhaps now more than ever. We've always used it over our 10-year history through these simple strategies to provide an extra lever of earning income. We always anchor our option targets and strike prices around our valuations, and we use it as a way to either trim or build positions. And the income that you're getting from options is likely to remain high for as long as earnings and dividends are uncertain. So it does provide a neat offset to reduced dividend income at the moment. So it can be a reliable source, it can be consistent through the cycle, and it can help when dividends are not providing as much income as normal. So we see increased uncertainty as something that we can use to our advantage without taking a significant amount of extra risk. As you'll see, options are utilised for us around defensive and quality stocks. Another example, which is a household name, is Coles. Now, Coles is the second largest supermarket business in Australia with 809 stores after Woolworths. As you'd imagine, Coles was relatively unaffected by COVID. In fact, Coles and Woolies and Metcash, the supplier, wholesaler to IGA, all saw a growth in short-term earnings around people's behaviours in COVID. They also saw a change in trend towards more buying and eating at home, and they were able to readjust their businesses, run some stores dark, and in fact, do better at their online fulfillment. So one of the few potential beneficiaries of the behavioural changes around COVID. Coles stands out as the business with 90% supermarkets, 10% liquor, slightly higher than Woolworths and Metcash, and it's got a very strong balance sheet and cash flow with low net debt. The new management team put into the Coles business at the time of the Wesfarmers spin-off last year have been making positive changes. One of our lessons in our 20-year lessons for 20-year books is about looking at demergers as a potential opportunity. We see demergers like Coles as a stark contrast to an IPO. So when the Coles spin-off occurred, management were actively talking it down rather than relying on an investment bank to talk up the prospects because their options presumably hadn't been set yet. And we ended up with a business with a lot more focus. So what was Coles management focused on? Coles earnings were close to 10-year lows when it spun off. Coles margin was 150 basis points behind Woolworths. And if you dug a little bit deeper, the reason for the margin difference was not sales productivity, but actually cost and efficiency. So what was wrong? Well, Coles had way too many distribution centres. In fact, I think Queensland was being serviced out of Goulburn. It had been underinvested. So what new management did was create a $950 million CapEx program to spend on warehouse consolidation and automation. They also renegotiated a number of long service contracts and updated their IT, underpinning $1 billion of potential cost out. So how do we invest in Coles? Well, first of all, when it spun off, we met management, we were comfortable with the business, we sold puts to target an entry price of $11. In fact, the stock got towards $11. After meeting management, we bought stock outright. The position did very well all the way through to January 2020, where it started to run beyond what we thought was fair value. So for our income fund, rather than trimming the position, we sold calls, collected additional income. In fact, we got exercise on some of those calls. Our Coles position reduced. Surprisingly, in March, due to the rapid fall in the market, Coles was dragged down with it. We were able to rebuild a position at $14 through stock and sold puts. And then we've since benefited from the run in the share price to the point where we're now running calls again. So you would not expect to see this level of share price volatility from such a defensive stock like Coles. So you see what we mean when we say we're positioning ourselves to benefit from the current volatility in the share market using options without taking significant additional risk in our stock holdings. Now, Amcor is another business that we've invested in as a core income holding. It's one of the largest suppliers of primary packaging in the world. And you'll see some of the packaging they offer. It's designed to protect food, beverage, and healthcare products, enhance their shelf life, and it also has an important role in branding products. Demand for this, as you'd imagine, similar to Coles, has been very robust through COVID under a variety of scenarios. And in fact, Amcor was designated as an essential service, the packaging of these goods through COVID. So their operations didn't stop. And 95% of their sales are to these defensive end markets. They're also a company that grows well by acquisition because of their scale and their efficiency of operations. They operate over 200 plants in 43 countries, and this provides a diversification of earnings, which gives us more confidence. You've seen this play out in the earnings and dividends profile for Amcor over a very long period of time. And this gives us confidence in owning Amcor for the dividend, as well as using option strategies around it. So the downside protection from Amcor comes through the fact that it has these major customers in the FMCG space. Think of the customers like Nestle, Unilever and Pepsi, all of which were very financially sound. The cash flows for Amcor are therefore strong. It was designated essential, so no business disruption. And it did sell off heavily in March as well. So you can see we first added to, we added to Amcor in late 2018 at around the $13 mark through puts and bought stock. It performed very strongly through to June 2019, where it had gone beyond our valuation. So we sold calls. In fact, we lost some stock through the calls. And then in March 2020, it sold off to the point where we could start selling puts and buying stock. Of course, then it's since run again, and we're starting to think about reducing our position through calls. This sort of volatility is not what we usually expect to see for defensives. So what we're really trying to achieve, looking at these companies, stepping back from the dominant parts of the market, the financials, property stocks that you usually look at for income, is sustainable yields and higher option premium. AusNet, as we saw, pays about a 5.4% yield with 50% franking. And again, in a low rate environment, the fact that that's growing means that it should command a premium, and we see it as very attractive versus some of the other property and REIT stocks listed in Australia. Coles, as we saw, defensive stock, pays a modest dividend yield. We can enhance that through option strategies. If we were to write a 3-month call option, we would generate about 3.5%, making this a 7% income stock. Similarly with Amcor, you're starting with a reasonable yield, and you can generate around about 5% option income. And Horizon has actually been surprisingly even higher than that, with starting with a 6% yield when we last bought it towards $4. So plenty of exciting opportunities outside of the banks and the property trusts. Now, we do have a strong record of delivering on the objectives of this fund. The two objectives are an income at least 2% above the ASX 300 yield in red, after fees and pre-franking. So you see how we've achieved that in the blue line for the last 10 financial years. In our financial year 19 distribution, we had a higher proportion from dividends. As you'll expect, currently a higher proportion of that distribution is coming from option income. But we do have very good forecasting capability in terms of generating that income and managing the risk around the portfolio. So really, our approach is to take a long-term view. The short term is anyone's guess. A lot of volatility will come our way. The best we can do is position our portfolio prudently. We are investing in equities to generate income, and that's key at the moment with rates so low, but you don't need to take undue risk in doing so. We've always avoided over-concentrating in our portfolios in banks and REITs, and we're also conscious that retail shareholders probably already have some shareholding directly in the banks or their hybrids. So the last thing we want to do is, increase the concentration. And we're also cautious of speculative stocks, taking valuation risk, and also buying cyclical stocks that are priced for a V-shaped recovery. We find many of these non-bank industrials are not priced for a V-shaped recovery, so we see less downside in their share prices. And if you can add to the fact that you can take advantage of volatility using options, some of the plain vanilla strategies you've seen today, you can get a bit more confidence, certainly more confidence than you might otherwise have in the ASX 300 yield itself. So we're keeping some powder dry. We did deploy some cash in March. It was a narrow window, but we put some cash to work on defensive businesses. Should we see more volatility, we'll do the same again. And it's really that diversity of income sources that gives us confidence in a more consistent income stream over time. So really, I hope today I've given you some insight into the way we're managing our portfolio for these uncertain times, how we're targeting income from equities, but we're doing so as prudently as we can, given the risks in the market, and how we're taking advantage of volatility using option strategies. So with that, I'd like to pause now. If you have any further interest in IML products, I do strongly suggest you talk to your state manager. The contact details are listed there. And I will pass back to Rob now and take some questions. Thanks very much.
Great, thank you, Michael, and thanks for such a, frankly, a super entertaining presentation. And you've covered it. You've covered a lot of ground, and I won't go through it all. But I'd be curious. We've got a question through here. Curious to know whether you've exited in any positions in response to COVID-19.
Yeah, it's a good question, Rob. We like to buy businesses that we have a high degree of confidence in and whose quality characteristics are enduring. So as you'd expect, we tend to be a very low turnover fund, in fact, less than 20% turnover. And where we do sell things, it's mostly on valuation. But it's fair to say this period was unprecedented. The red flags for us in this environment are companies with strained balance sheets or cash flows, or those whose valuations just don't stack up, sorry. There were two positions that we did exit through this period. One was a position in Sydney Airport, a very strong quality monopolistic asset that we bought on a reasonable price in a low rate environment. And we actually bought it quite well, but by the same token, given the moratorium on flying, given the amount of money they earn on the car parks, their revenues were very exposed, and they do carry a lot of debt. So in the normal course of business, they should be able to carry a lot of debt, but in this environment, it puts them at risk. It puts their balance sheet at more risk than normal. So we exited that very early in the piece as the market was falling late March. The second one is a property trust that came out of the Westfield Group. It's Unibail Rodamco. They own flagship assets in shopping malls in the world, including in New York and UK and throughout Europe. These are the best assets in the world. It's the top class mall assets where all of the luxury brands need to go just for branding purposes, and they're actually growing footfall. And that we bought at a discount to the stated valuation of the property, and the company was going through a process of selling assets at a premium to what they held them on the book and reducing debt. Of course, even if you're growing foot traffic ahead of COVID and your balance sheet position is underpinned by asset sales, you shut the doors, the music stops, we needed to exit that position. Yeah. Outside of that, we found ourselves doing more buying than selling, adding to our defensive positions at the bottom, things like Coles, Amcor, Horizon, even Brambles, Telstra, plenty of opportunities in March.
Yeah, thank you. And I took from your presentation, frankly, your it goes without saying, but your long-term approach, you've got a high degree of discipline. And I think I'm almost answering it, but why do you feel so confident that your fund can continue to meet its objectives, considering we don't know what's happening tomorrow?
Yeah, no, it's a good question, Rob, and we do keep a very close eye on the constituents that make up our fund. I think what really gives us confidence is the stocks. So the stocks in our portfolio are predominantly defensive companies that may have some growth, even in some cases contractual growth, and they don't have a great deal of balance sheet risk. Mm-hmm. So if you think Coles earnings in 5 years' time are underpinned by $1 billion cost out and supermarkets are not particularly exposed to COVID, that's a good position. Of course, it's done well, so we've started to reduce it. AusNet, again, it's almost a bond proxy type stock with low rates and a 2 to 3% growing distribution. With rates at the levels they are, that asset should be carrying a real premium. So we see our positioning as solid, and we see our ability to generate option income as very strong, making up for a bit of lost dividend yield. And we also see our portfolio as having a degree of downside resilience because of those defensive businesses and because they will prove to be the safe haven should we have another sell-off.
I've just got a question through here, and I know I alluded to it in the introduction, but on the front page of the Fin Review today is the announcement from APRA with regard to dividends. Could the question is, I'd like your view on that. What does that really mean?
That's an interesting topic. It is good to get some clarity from APRA. The market has certainly been seeking some for a while. We saw the banks put cautionary statements on dividends at the start of this period. The difficulty in forecasting dividends has been the bad debt scenario. And on the one hand, the measures to support the industry have helped because banks haven't had to recognise bad loans through their accounting in the normal way. They've created provisions based on scenarios. And the same has happened in the regulatory capital treatment. So what we don't know is what the economic environment will be post deferrals. What we do know today is that APRA's come out and explicitly put a cap on dividend payments. And what they've said is for the remainder of the calendar year, banks are encouraged to retain at least 50% of earnings on balance sheet, so they can pay out less than or equal to 50% of earnings for the remainder of the calendar year. This is perhaps slightly more flexibility than people might have thought. There is an argument that all dividend payments should be stopped, but equally, there's also an expectation that banks should not run down their capital levels for the sake of dividends. So if they are paying out and dropping between certain tiers in regulatory capital levels, they're expected to do a bit more raising on the other side, just to make sure that buffer is actually used to support customers and the economy rather than pay dividends. So I think it's a tricky spot for people relying on dividend payments. For example, when Commonwealth Bank comes up for its August dividend payment, you could see them underwriting their DRP. You know, there is actually an argument that they're priced at quite a premium, so that perhaps like NAB, they should be raising money. But, you know, we certainly don't see a return to normal dividend payments until we see just how deep this economic scenario is. In the event that we have a real tail risk scenario, the key will be preserving as much capital as possible.
I think it was pretty interesting. I think the numbers you said, there was $2.8 trillion in lending from the banks. Something less than that was mortgages.
Yeah, 1.7. That's right.
1.7 trillion. 500,000 people in deferral. And then you said, you know, frankly, it's a big piece of work for the banks to work through to see whether those are truly, so they might be in deferral, doesn't mean they're in distress.
That's right. And the early numbers we've seen have called out that a manageable portion of them are in distress, or, you know, if the bank manages their transaction account, they might have seen a change in income that puts a red flag. The problem is we don't know how big a sample of people the big banks have been through. And in fact, being a bigger bank almost has diseconomies of scale in this environment. They're building up their teams of people. They usually have hardship teams to go out and investigate these mortgage arrears. They're building those teams. They're looking into SME loans very carefully too, because the last thing the government wants is banks starting to foreclose on family homes as collateral for SME loans. The problem is data.
It's not a vote winner either.
Across all the banks.
It's not a particular vote winner though, is it, Michael? Foreclosing
no, absolutely not. And I think that's the last thing anyone wants to see happen. So, you know, hopefully providing time and providing concessions will allow banks to work through it. But while that persists, the quid pro quo is preserving capital.
There's a question that's come through. I'll just read it directly because I'm not completely familiar with it. But do you think the government will change the BHP and Rio Tinto mining tax as based on last year's joint turnover? This possibly could recoup the $91 billion to help pay down government debt. I'm not all familiar with that.
Look, to be honest, with reference to a mining tax, I'm not sure. I'm not close enough to that. Certainly the resource companies have done very well out of high commodity prices, particularly iron ore, so they're in very strong capital positions. Of course, the sustainability of their dividends is also in question, given the cyclicality of those commodities. I think there will be pressure to raise tax wherever the government can. I'm not sure to what extent it come from the resource companies, but I think it'll be front of mind.
Yes, yeah, absolutely. Thank you. I just want to pivot back to risk and how you manage risk within this portfolio, or maybe just IML more broadly.
Yeah, so our main risk management tool is our stock picking. So we try and fill our portfolios full of quality stocks that we think can withstand difficult scenarios and are underpinned by strong dividend yields, which we see as sustainable. So sustainable yields, sustainable valuation, nothing exuberant in terms of valuation. So how that translates into our equity income fund is you start with that bank of stocks and you use your valuation targets to drive everything you do. In contrast, there are equity income strategies out there that will write options systematically, or they will target stocks for income and strip dividends and franking regardless of the fundamentals. So they can end up being high turnover strategies, so the sustainability of the income for those is more difficult. We also manage risk by never taking counterparty risk with an investment bank. We only trade exchange traded options where they're listed on the ASX, and we don't gear or short at all. We're a long only portfolio. If we have calls that we've sold, there's stock on the other side. And if we have put options that we've sold, we've got cash to back that. So we're never a forced buyer or seller of stock. And equally, we manage our cash conservatively. We give ourselves a buffer so that if the market runs, we're not covering too many stocks with calls such that we have to chase our tail into a rising market. And we've always got a bit of cash in reserve just for opportunities that might arise if volatility comes back. So a very, very simple approach, but some strict disciplines to avoid some of those scenarios where you can get trapped with income generation.
Fabulous, thank you. I know that we were talking about the banks just prior to and where they're at, and I understand your position on banks, but provocatively, if you had to own one, which one would you own?
Yeah, it's a good question because they are such a big component of the index. They're all similar banks. I mean, the books are a product of the history that they've been through. So they're all driven by the same fundamental things, but by the same token, they're not all valued the same. And they all have different management and a little bit of different focus. So the one I'd call out is NAB. We see NAB as having a management team that has very strong experience with dealing with difficult scenarios like that we see today, and also a very strong chairman. It has changed. The NAB of old was a long laggard against the sector. They have divested some business, put their focus behind what their core franchise is, their SME franchise, and also home lending. They've simplified their business. And I think that at the moment, having experience in working through a recession is key. And there are very few Australian bankers who have really had that experience. We see it as having some valuation appeal versus the others, trading around about book value on a decent yield. By the same token, the last thing we want to do is put too much money into banks as a sector.
Yep. I'm sure Phil Cronican would thank you for that endorsement. Final question before I summarise, Michael, if I could. So, what sort of companies can sustain or grow their dividends in this environment? What's your sort of view there?
Yeah, so I think the companies you need to look for are the ones whose earnings growth are driven by their own initiatives. So think about the scenario of Coles where you're cutting costs to improve your earnings or improve your margins. Amcor, where you've got a very big scale benefit and efficiency, which means you can make low-risk acquisitions to grow your earnings. Contractual growth, of which stocks like Horizon and AusNet have some predictable earnings profile, and also companies gaining market share. So there are some beneficiaries of structural change One I'd call out is that benefits from structural change potentially is Orica, with a shift in blasting technology that's going on that could well see management making market share gains. So these are very stock specific. These have nothing to do with the economic environment, and where you can find out that a company has a true advantage on one of these fronts and it's predictable and the underlying business is secure, you can actually forecast earnings with some degree of confidence 3 years out. The market's earnings, on the other hand, is anyone's guess, and I expect to see a real spectrum of different outlook statements, or perhaps many management not willing to give outlook statements in August.
Thank you. I just had one more question that's come through, which I thought I'd put to you. The government and opposition seem to be open to some form of tax reform. Do you see any sensitivity in your portfolio to a comprehensive change in the way tax is collected, so potentially affecting free cash flow? It's a pretty broad question, I know. But,
that is a broad question, and I'm not sure I'm qualified to answer that at this point. I think there's a lot that's been considered at the government level about collection of tax. And look, reform has been on the agenda since I worked in Treasury, 15 years ago. So
yes.
Look, if I understood politics, I'd be in a different place now. But yeah, I think something has to give, given the level of deficits we're running into. So, and certainly it's a very politically loaded area.
Yeah, thank you. And last question, and this is just about how you react to market. So if the US has a downturn in their market, how do you? The question here is how do you position for that, and how do you not get caught in their downturn? How do we not get caught, or your portfolio? From that?
I like the way that question's phrased, Rob, and it points to what is a lot of strong themes in the market.
Yeah.
The US is obviously a very tech-heavy market, where the technology sector has been a big driver of their rally, and obviously the economic environment there, the market is really benefiting as well from the actions of the Fed in buying junk bonds, in propping up asset value. So those themes have seen the US market go beyond what we thought was any form of reasonable valuation. Mm-hmm. How that's impacted Australia is we've seen the same themes in parts of our index. So our index composition is a lot different. We've got about a third financials and about a third resources, and the rest in industrials. We haven't got a very big tech sector. So financials have largely been held back, as they should, because the economic environment is uncertain. Resources have been propped up by what we see as unsustainably high commodity prices. Although they have decent balance sheets, we think their dividends will be tested. And the industrial sector in Australia is actually commanding quite a high valuation on a PE basis in the high 20s. So we think we have the same valuation exposure as they do, and we think it's very much skewed to the same sectors, although it's a smaller part of our index. So where we're quite concerned is the technology valuations, which are on multiples of revenue. And it's a very different mix of companies to the industry leaders in tech we see in the US. But equally, we're less worried about the non-bank industrial part of the sector. So our protection from a US correction is in buying into defensive safe havens that people will run to, mm-hmm. because they're underpinned by a high dividend yield in the event of another correction. Now, they may get dragged down with the market in line, as they tend to. Every time the market sells off, things tend to gap, but the good companies show their worth over time as the dust settles.
Thank you, Michael, and thank you for taking the time today. I'd just like to congratulate you for giving such a candid presentation. I'd like to sort of acknowledge some of the areas that you covered personally, and just a couple of takeouts. I mean, I'm pretty sure I heard you say that you're looking at a V-shaped recovery. I'm touching on the IML criteria. I thought this resonated, and who wouldn't want to look at, you know, competitive advantage, recurring revenue. I liked what you said about capable management. You know, not everybody's been through a pandemic. So, you know, how you assess capable management, someone that's growth orientated and at a reasonable price. Appreciate you touching on the banks. I mean, frankly, that was a staggering number at $500,000 in deferral. The story around the Zara stores, you know, 2,100 stores. I think you said 500 closing per annum for the next 3 years. I mean, that's and redirecting to online, and how that affects property trusts, office property. I mean, I think we all see it if you're in any of the capital cities, who's going into the office and who's not, and office valuations being exposed. Thank you for sharing the stock stories, AusNet, Horizon, you know, the largest rail and freight network. I think what was particularly interesting, I think both the stats were interesting, but 60% of that income is regulated. And I think that goes to your story about ensuring surety around revenue. And we had that through there. Your option strategy, or taking advantage of an option strategy. I think that buy-sell discipline, I think you said you had 10 analysts looking
That's right.
at stocks, right? So, you know, there's a certain attitude that you need to be able to do that, and it was really interesting to get an insight to that. And of course, Coles and the Coles and Amcor story. I think we all resonate with the Coles story. 809 stores, the change of management, and frankly, the ability to take advantage of online fulfillment in this market. So, Michael, I'd like to thank you. I'd like to thank the team at Investors Mutual for pulling this together. It's super, super interesting in a market where people look to traditional things like banks for dividends, and taking us through, you know, your view of the planet and how you grow or deliver that value to your customers and clients. I'd like to thank the people who took the time to register today and to log on. Thank you so much. As we said, your certificate will be out to you within the next week. And of course, this presentation will be online on the AFA site. So again, thank you, Michael, the IML team. Thank you to all the folks out there who have tuned in. I wish you a very good afternoon at 3 minutes past 12. Many thanks and good afternoon.